Good morning, everyone. Today we are diving into a critical topic in the world of international business and taxation, transfer pricing and international transactions. For businesses and operates across the border, understanding transfer pricing is not just important, it is essential for compliance, minimizing risk, and optimizing tax efficiency. So the first question comes up, what is a transfer pricing? Let's start with the basics. Transfer pricing refers to the pricing of goods, services, or intangible assets exchanged between the related entities within a multinational enterprises. For example, if the parent company is in US, sells product to its subsidiary in India, the price they charged each other is transfer pricing. Now, why this is important? Because the price can impact the taxable profit in each country. Authorities globally have strict regulations to ensure that the transfer pricing doesn't lead to profit shifting to the low taxation countries or tax cannot be avoided. So one of the important principle emerged in the transfer pricing, that the arm length principle. The backbone of transfer pricing rules is the arm length principle. It states that the price set between related parties should be the same as it is would have been between the unrelated parties in similar conditions. Let's say a company A in India sells a product to its unrelated customers for $100. If it sells the same product to US parent company for $50, then it's a red flag for the tax authorities. India follows the guidelines under the Income Tax Act 1961, particularly Section 92 to 92F, which lays out transfer pricing rules. To determine the arm length price, five key methods are prescribed. First, comparable uncontrolled price method, that is called CUP method, comparing prices of the similar transactions between unrelated entities. The second method is resale price method, in which price at which goods are resold to independent party less the profit margin we have. Third method is cost plus method, which includes adding a markup to the production cost. Fourth method is transactional net margin methods, evaluating the profit margin from transactions. The fifth method is profit split method, allocating combined profit from transactions between related parties. The authorities can also prescribe any other methods which they find suitable. Now, we have to do documentations and compliances in transfer pricings. So one of the biggest challenges in transfer pricing is documentations. The Indian tax authorities mandates maintaining a master file outlining the global operations of the group, a local file detailing Indian operations, and country by country reportings for M&Es meeting a certain revenue thresholds. Failure to compliance with these requirements can result in a hefty penalties ranging from 2% of the transaction value to 300% of the tax avoided. So, what are the common issues in transfer pricing? Business often face disputes due to incorrect valuations of transaction, inadequate documentations, and disagreements over applied methods. Notable case laws includes, have you heard about the Vodafone India services, where the transfer pricing adjustments on share valuations has been done, and in the case of Maruti Suzuki India Limited, disputes over the royalty payments. These cases includes more complexities and the need of accurate compliances. So the India had introduced tools like safe harbor rules and advanced pricing agreements to reduce litigations. So what are the safe harbor rules? Simplifies the compliance for eligible taxpayer. For example, IT's company with a specified profit margin range can avoid scrutiny. And the other method is advanced uh, transfer pricing terms with the tax authorities for future transactions. So that is called APAs. Now we have to talk about the global development in transfer pricing. Transfer pricing is not just a national issue, it's global. The OECD and BEP's action plans aims to combat the base erosions and profit shifting by enhancing the transparency and implementing consistency rules across India. So India being a part of the initiative and aligning its regulation accordingly. So we have to summarize the topic. To summarize, transfer pricing is a critical area in the international transactions and demand precision compliances and strategic planning. By understanding its principles and staying compliant with Indian regulations, business can minimize disputes and contribute to a fair ecosystem. Thank you, and feel free to ask any questions. Thank you.